Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Welcome to Fidelity Soundbites. I'm your special guest host, Tim Conley, Head of Institutional for Fidelity Australia. Thrilled to be hosting this award-winning podcast, just keeping the seat warm for Lucas de Paulbay, who will return next episode. Today we're going to be discussing pre-IPO investing and more specifically, pre-IPO investing in Asia. Joining me today from our Singapore office is Dale Nicholls, PM for the Fidelity China Special Situations Strategy and for the Asia Pre-IPO Strategy. And from our Hong Kong office, we have Tony Liu, Investment Director for Private Markets. Gents, welcome to the podcast.
Hi, Tim.
Hello.
Now, you were both out here not so long ago in mid-December, and we hosted a fantastic set of meetings with institutional investors. And it's clear there's a lot of interest in both Asian equity markets, in particular China, as well as the area of pre-IPO investing. Tony, if we perhaps start with you, how do we define this area of pre-IPO investing, or what is also commonly known as growth investing?
In our context, pre-IPO investing is essentially late-stage venture. Some people call it growth equity as well. They pretty much mean the same things. It sits between your traditional venture capital, which is early-stage companies, and public equity. What that means is we tend to look at late-stage, more mature private companies. They normally have proven business models, steady revenue streams. They may or may not be profitable, but in most cases, they will have a clear trajectory to profitability. So the question we ask ourselves as investors is no longer, can this work? The question becomes, how big, how scalable, how durable can the business be? And on the flip side, the risks are less so about product market fit or about technology disruption. It's more about execution, about competition, and about governance. And we also hope that these companies are ready for IPO in the near term. So our expectation as a pre-IPO investor is 2 to 3 years after our investment, there will be a liquidity event, which is normally an IPO in the Asia context, and we will achieve some level of return from that event.
And the strategy, of course, is focused on Asia. And Dale, you've been with Fidelity for almost 30 years. I think this May is your 30-year anniversary, in fact. And you've been based in Asia for that entire time. What first attracted you to investing in Asian investment markets?
Yeah, I started actually in our Japan office. So as an analyst looking at Japanese stocks, and don't want to go back too far, but this was a time when, Japanese businesses were obviously, expanding rapidly. There was a lot, as a student of business, there's a lot of talk of, Japanese management techniques, just in time, Kanban, that sort of thing. There's a lot of interest there. And I was, again, lucky enough to be on the ground as an analyst looking at those areas. As an analyst as well, I was also looking at the tech space. And through that, got a chance to look at the early emergence of some of the really competitive companies out of markets like Taiwan, Korea, many companies of which now, as you know, are sort of enabling what we're seeing in AI. And then obviously after that, we saw huge growth out of China as well. So as an analyst, got a chance to look at those areas. Then I took over the Pacific Fund, which, obviously investing directly in all those markets. And, the area just continues to develop. I think stepping back, it would be hard to find a sort of more vibrant, opportunity-rich area globally, really. Very diverse, a lot of really competitive companies, a lot of change. Yeah, I still see, a lot of opportunity ahead.
And Dale, you took over management of the China Special Situations Strategy in 2014 from the great Anthony Bolton, legendary Fidelity fund manager. He'd been managing the trust since its inception in 2010, and Anthony, of course, handpicked you as his successor. And you've been visiting China since, I think, the late 90s when you're an analyst. Just talk us through the evolution of the China equities market over that time and some of the structural changes you've seen over that period you've been following it.
Handpicked might be a bit strong. I was, obviously it was went through a process with the board. But yeah, I mean, having Anthony's support there, I'm sure didn't hurt. The evolution of China is really just incredible. If you just sort of step back and obviously look at, you have the overall economic growth that we've seen over that period, obviously slowing now, but still significant. But just, looking at the individual industries and companies, there's just been a massive change. In fact, you sort of step back and I think it's hard to find an industry where the competitors or the companies have not become more competitive over time. Globally, I mean. Obviously, this is on the back of massive investment in R&D, massive increases in scale, et cetera. But, just across a range of industries, China's just become more competitive. And in some cases, look at an industry like autos, where we started, as sort of JV partners relying on overseas technology. And now, the Chinese companies, the private companies that have emerged are the most competitive globally, leveraging China's strength across the whole battery supply chain, which is, of course, supporting a whole range of industries. But that's one example, but there's just many examples where the companies have just become much more competitive over time. And that's been reflected in the markets as well. I mean, the early days, it was really SOE dominated. It was an SOE dominated market, in fact. It was, you had the banks, telcos, energy, as I said, SOE dominated. And look at the market now, and you've got, it's dominated by private companies. You've got, the whole technology space, where again, you've got a bunch of companies that are globally competitive. So, the change is really significant and really showing no signs of slowing.
Yeah. So, I mean, as you alluded to, I mean, we've been looking at, private companies as well as publicly listed companies for many years. It's an important part of your analysis. So pre-IPO, it's not a new area for Fidelity, and China Special Situations can invest up to, I think, 15% in unlisted companies. So you've had experience in that private space. Maybe if you could share some of the pre-IPO success stories in China that you've been involved in.
Yeah, I mean, it's a really important part of the strategy. Obviously, we want to, sort of access all the best opportunities, in the Chinese market. And as we know, sort of, companies are coming to market later globally, and China's no exception. So again, it's a really important part of the strategy and has done well for us over time. You ask about some of the examples. Obviously, Alibaba would be probably the biggest initial success for us. But, post that, there's a lot of other names that have contributed as well. You look at a name like ByteDance, which is still private, but it's actually the biggest bet we have in the portfolio, and obviously the biggest private holding we have, over 4% of the portfolio now. And, that's probably up 6-7 times since our initial investment. We've added to it over time. And I would argue that our valuation that we're putting on it is still pretty conservative, just given the pace that we're seeing in the business. And still a lot of optionality there. Obviously, we're all aware of TikTok globally. A lot of monetization potential there outside of China as well. So that's one we're still very excited about. Other examples, you'd be familiar with DD in ride sharing, Meituan in food delivery, other names like Full Truck Alliance, SenseTime in the AI space. There's really a range of examples that I could share. But yeah, it's been a sort of really, rich area of opportunity for us.
And Tony, you come from a private equity background. And so when we look at this strategy and sort of points of differentiation, what would you say you see as Fidelity's edge in this area of pre-IPO investing?
I think our most important competitive advantage is the brand, because brand takes the longest time to build. And Fidelity is known in the market as a fundamental-driven long-term investor that can support these companies both in the private market and in the public market. That brand cannot be built overnight. And I think the brand equity increasingly resonates with founders, especially founders of high quality companies, because they would want high quality investors on their cap tables as well. Having the Fidelity brand on the cap table strengthens the IPO story significantly. And so that allows us to have better deal access in a private market, get priority access to the management teams. Sometimes we get into deals that most of our peers can't. Sometimes we get slightly better terms to protect on the downside. And so I think that's just an incredible asset that we have in the private market. Second, I'd say the way that our research resources is structured is also quite unique. Again, to your point, compared to most of the pure play private equity shops, especially in Asia, they typically have a large team of journalists covering different sectors, different geographies. What we have instead is a team of experts. So we have our industry analysts in each of the major markets here, and that provides us with the continuity in research. So hopefully drives better insight and also increases the touch points that we have with important stakeholders that can also drive deal flow. And so I feel like there is just a lot more that we can use, resources that we already have to increase what we can do in the private space.
And are there particular sectors that you're finding more opportunities in the private space?
Yeah, absolutely. I think it's worth to take a step back to understand the return drivers of the strategy so that we can better understand how we prioritize. If you think about the type of investments that we make, these are normally minority investments in, again, late stage private companies. And at the end of the day, there are really two things that drive returns. One is the compounded growth rates of earnings of these companies. Second is the difference of entry and exit multiples. The second factor, in fact, is normally a negative factor in our return calculation because when companies are growing fast, they normally need a higher multiple. And so multiples tend to contract in normal market environments. And so we really do need the first input to be really high to drive the return that we desire in the private market. So we really do need to look for companies that can grow. And we also don't want that growth to be short-lived. We want that growth to be durable because unlike public equity, in the private market, the investment horizon is normally longer. We're talking about 3, 4, 5 years. And so we want to back trends that can last for at least that amount of time. And so technology is obviously a sector where you see a lot of growth in these days. And I'd say, technology is a word that should be used pretty broadly as well these days, because when we say technology, we not only just look at AI or semiconductors or robotics, we also think about how technology can change traditional industries. And so if there is a long-term view that we think a slow-growing industry can be transformed by tech, that will also be an area that we can play. And so tech by far is the most prevalent theme, and I think it will remain the main theme in the future.
Dale, let's come back to China for a moment. Always a big topic of conversation. As you've said before, sentiment can swing very wildly on China from ambivalence to euphoria and then to extreme negativity. And you hear phrases like China is uninvestable. The market had a tough period post-COVID, but last year it was up very strongly. So what's your current outlook for the China equities market? And also, what would you say to investors who remain concerned about the geopolitical risks associated with investing in China?
Yeah, I mean, you're absolutely right about the volatility. It's actually, as a bottom-up investor, something that, actually creates a lot of opportunity if you're, you focus on the fundamentals of individual companies as we are. I'm still quite positive on the market. Obviously, China is traded at a really significant discount to global markets, obviously, particularly versus the US. But I think the ingredients are there for that discount to close over time. At some point, we always wonder if policy certainty will sort of enter into the equation. I think in general, you can say China's been fairly consistent. We've just begun our 15th five-year plan. So, the government is pretty clear about their targets and policies, and that's a good guide for us, actually investors, of where they're trying to take the economy. At the same time, you could probably argue that some of the other policymakers and countries out there are maybe less predictable. So again, I think the ingredients are there for things to gradually improve. I also think there's increasing realization of just the competitiveness of companies, that we talked about. Again, that significant investment in R&D and CapEx is really leading to, increased competitiveness. And my sense is that is starting to get recognized globally. And then more broadly on the economy, we've been through, a relatively slow period. But again, I think the ingredients are there for things to gradually improve. I mean, we're definitely past the worst of a pretty significant property slowdown, pretty significant correction. And, the supply side of that equation is adjusted significantly and the underlying demand is there. So I think it's sort of a matter of time, and government policy will help that, pricing starts to stabilize. And that's important for the other big part of the economy, which is consumption, which I think that has clearly been a drag. And, I think, the consumer has clearly underspent, you mentioned since that COVID period. And as a result of that, you've got very cashed up balance sheets. So, that sort of lack of consumer confidence has been a drag on the economy, but, hopefully that can start to change. And then, I'm also actually quite positive on sort of the investment around areas like AI. The companies that we talk to are definitely ramping their investment. We know the sort of impact that has had in terms of economic growth in places like the US. I think China has definitely lagged in that level of investment, but we do see signs that that's starting to accelerate. So again, that against a backdrop of, relatively cautious sentiment, I think bodes well for the outlook for markets from here.
And Tony, just finally, the outlook for IPOs in Asia for the remainder of 2026, what sort of supply are we seeing at the moment?
25 was a great year for Asia IPOs. Total proceeds, I think, doubled year over year across the regional exchanges. And I believe, above 50% of global IPO proceeds last year were actually raised in Asia. So obviously, one great year last year, and there is some continuity of that momentum this year, especially, in parts of Asia, such as China. You have over 300 companies waiting to go public in Hong Kong. So it's a very strong pipeline. So I continue to believe that it's gonna be a great year.
Well, thank you very much for joining us. It's a really exciting area, huge return potential, and we look forward to seeing how it develops. And I know both of you will be out here later this year, so look forward to meeting with more clients again. Dale, Tony, thanks for your time.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only, as being prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.